Have you ever felt like the market has a mind of its own? Like it's just completely random? Well, what if I told you it was actually following a kind of hidden calendar? Today, we're going to unlock that calendar and see how certain times of the year can give us huge clues about the market's next big move.
All right, welcome to AI Explains ICT. In this video, we are diving deep into the concepts from Core Content, Month 5, Episode 12. And I'm telling you, you'll definitely want to grab a pen and paper for this one. The ideas we're about to unpack are absolute game changers for building that long-term macro view of the markets.
So just ask yourself this: what if you could anticipate the market's next big move, not with some fancy, complicated indicator, but just by looking at the calendar? That's the really powerful idea behind what ICT calls ideal seasonal tendencies.
So here's the game plan. First, we'll look at why these tendencies are like a hidden roadmap for the market. Then, we're going to define what makes a tendency ideal. After that, we'll dive into some real-world examples from spring and summer. I'll show you how to blend this analysis with other tools, and we'll wrap it all up by talking about how to build your own seasonal calendar.
Okay, so let's start with the big idea here. This is not about finding a crystal ball that predicts the future. Nope, it's about using history as our guide, finding those paths that price has taken before, year after year.
And you know, ICT puts it perfectly with this quote: "The most important thing to get is that these are not guarantees. They are historical roadmaps. They show us what's likely to happen because it's happened so many times before, and that gives us a powerful probabilistic edge."
So what exactly is a seasonal tendency? Well, it's just a historical pattern where price tends to move a certain way during a specific time of year. But listen, the most important part is right there on the slide. This is a tendency, not a guarantee. It's not going to happen every single time, but man, it gives us an incredible framework to start our analysis.
Now, not all tendencies are created equal. So what separates a decent one from what ICT calls an ideal one? Well, that's exactly what we're going to break down next.
The process is actually pretty systematic, which is great. First, you compare the seasonal charts of two different currencies, let's say the Australian dollar and the US dollar. You're literally hunting for times when they are moving in complete opposite directions. You want to zero in on the strongest, clearest patterns that just jump right off the chart. When you find that perfect opposition, you've qualified an ideal scenario for that currency pair.
Okay, let's look at a real example so you can see what I mean. On the left, we've got the seasonal tendency for Australian dollar futures, and on the right, the US dollar index. Just take a second and look at the flow of price through the year. Can you spot a time where one is clearly going up while the other is clearly going down?
If you look really close at that period from March to May, you see it. It's so clear. The Australian dollar has this powerful historical tendency to rally. And what's the US dollar doing at the exact same time? It has a strong tendency to fall. That right there, that is the diametrically opposed price action we're looking for. It's a huge signal for an ideal seasonal setup for a rally in the Aussie dollar.
That March to May window is a classic spring setup. So let's explore a few more of the major pairs that often show these strong, predictable tendencies during this time of year.
So let's just lock in what we saw on the chart. From March to May, the Aussie dollar historically shows a strong rally. At the same time, the US dollar index shows a sharp decline. This creates a powerful tailwind for anyone looking to go long on the AUD/USD pair. And it's not just the Aussie. The New Zealand dollar shows a really similar pattern. The Kiwi also tends to rally into May, right when the dollar is typically selling off. So this is another classic spring setup to keep on your radar. The pattern repeats itself again with the British pound. Cable often forms a seasonal low in March and then rallies into May, which perfectly mirrors the dollar's tendency to form a high and then sell off. It's just a textbook inverse relationship.
And here is what that looks like on the charts for the British pound versus the US dollar. I mean, look at this. On the left, you can see the pound forming its March low and starting that climb. On the right, the dollar is doing the exact opposite. It's peaking and starting to fall. That beautiful alignment is what creates such a high probability setup.
Now, you've probably noticed the two different colored lines on these charts, and it is absolutely crucial to know what they mean. The blue line, that represents 40 years of historical data. That's the really big picture. The red line is the more recent 15 years. Now, when you see both of those lines moving together like they are in these examples, that is a massive confidence booster. It means the seasonal tendency isn't just old news. It's strong, and it is held up in the modern market.
All right, let's shift gears a little. We're going to move our focus from spring to summer. The calendar turns, and just like that, new seasonal patterns start to emerge that we can look for.
A really classic summer setup involves the euro versus the US dollar. During that June to July period, the euro has a strong seasonal tendency to form a low. And at the very same time, the US dollar index tends to be forming a seasonal high. See the pattern?
And here's the visual for that exact summer scenario. Just notice how the euro carves out a bottom in that June-July window, right as the dollar is putting in a peak. For a long-term trader, this is an invaluable heads-up to be watching for a major turning point in the euro-USD as summer gets going.
So we have these really powerful seasonal roadmaps. But how do we actually weave them into a complete trading plan? It's not just about finding two opposing charts. There's actually a more nuanced, a smarter way to approach this.
And here is the big aha moment from ICT. You don't always need both currencies to be in some perfect opposing long-term trend. He says you only really need one. Now, this is a total game changer in how you can apply this information.
So let me explain how that works in practice. Imagine the Canadian dollar is already in a strong long-term uptrend. The US dollar, meanwhile, might just be chopping sideways, not really doing much. But when you get to that March/April window where the Canadian dollar has that seasonal tendency to rally, that combination can be more than enough to create a high-probability short setup in USD CAD. You're blending an existing trend with a seasonal tendency to find that perfect timing.
Okay, this all leads to a very practical application: creating your very own seasonal calendar. This is what transforms seasonal analysis from just an interesting idea into a core part of your daily routine. ICT recommends starting every single trading day with a macro review just like this. Look at your calendar. What month is it? Which pairs historically have strong tendencies right now? You can write this stuff down ahead of time. So for example, when March rolls around, you already have notes telling you to be looking for strength in the pound, the Aussie, and the Kiwi against potential dollar weakness. This keeps you prepared for these major, long-term setups way before they unfold.
So there you have it, a peek behind the curtain at the market's hidden calendar. And the real question is, now that you know about these tendencies, are you ever going to be able to look at a chart in March or June the same way again? If you found this video helpful, please give it a like and subscribe to the channel. If you have any questions, drop them in the comments below, and a real human will get back to you. Until next time, good luck and safe trading.